Welcome to MarketTamer.com. We've got a chart up of Apple here. Apple has made a tremendous surge since its March lows and has bounced really from around the 80-85 level all the way up to about 130. So a couple of questions came in today regarding how to trade against Apple. There are lots of ways to do this, lots of strategies. And so the ones I point out here obviously do not constitute recommendations to buy or sell any securities here. As always with any of these videos, we're discussing educational concepts, and any choice to go ahead and place any trades is solely up to your own discretion and risk tolerance, etc., etc. So with all that said, let's take a look here. One way of potentially betting against Apple is to look at a bear call. Now, as we know, bear call takes advantage of stagnant or declining trends. In fact, if we place the short call of the bear call above where the stock is currently placed, we can even take advantage of a slight uptrend. That is, provided the stock doesn't go up higher than the strike price of the short call. So for example, that means if we had a 140, 145 bear call in place, even if the stock rose all the way up to 140, we could still make money by expiration. So for May, that's a few weeks away right now. If the stock stayed flat at 130, we'd make money. If it dropped, we'd also make money. So it's a pretty nice trade in that regard. However, what's not attractive about the trade is the trend. The trend is obviously higher, and it hasn't shown any real desire to slow down. With that said, one of the analyses we can do is simply a very quick view of time frame versus price movement. For example, if I knew that the expiration date was, say, 2 weeks away, then I would go back and say, how far has this stock typically moved over any 2-week period? And the first thing I'd probably do is discount the initial surge here in March. This was a very, very sharp bounce off a very long and protracted downtrend, and so the movement back in March is almost certainly not representative of the movement that will take place 2 months into a rally. Usually rallies obviously last for extended periods of time, but they tend to peter out, and ultimately, as with everything, it will rise up and then there'll be an inflection point. We'll see the stock come down again at some point. It may only be a test, and that may be leading to a resumption higher, but nonetheless, that's the cycle, and that's what we should expect. Nothing goes straight up, nothing typically goes straight down, unless potentially it's a financial stock, but we won't go there in this video. So that said, what I do is probably take the angle of the trend right now, so discounting this very steep rise, and look to the consistent trend we've seen over the past month. Go back any 2-week period in that month and see where does the stock move to. Well, from the start of the month to the middle, we went up from about 110 to about 120. Then we went from 120 to about 130. And so with 2 weeks to go to expiration, could I extrapolate here and say potentially the stock will go on up to 140? Yes, that would be reasonable. And so if I think it's not going to break above that 140 level, I could certainly take advantage of a bear call. If my target exit point was for those options to expire worthless, that might be a very good trade, could work out quite well. However, there is never a reason to place a trade without having a contingency exit plan, and obviously that's what we specialize in at MarketTamer.com. So if this is a type of strategy that might interest you, feel free to jump into classes with the guys, and we'll be delighted to discuss further what those exits would be.